Hello and welcome. Today we're walking through 4 takeaways from the Federal Reserve meeting, as reported by Colby Smith in the New York Times. The piece, titled 4 Takeaways from the Federal Reserve Meeting, breaks down the key developments from the central bank's latest policy decision. The Federal Reserve held interest rates steady at its latest policy gathering on Wednesday, but the decision masked a significant fracture among policymakers. The first takeaway: 3 officials broke ranks and voted for a quarter-point rate increase. That dissent tells us the debate inside the central bank has moved beyond whether borrowing costs will rise, to a question of when. In practical terms, the vote breakdown shows that 3 members of the Federal Open Market Committee wanted to raise the benchmark rate by 1/4 percentage point, while the majority opted to keep it unchanged. This split indicates that the internal conversation has shifted from a debate over whether to tighten to a debate over the timing of the next move. The article notes that officials have splintered over how the central bank should tackle elevated inflation. The second takeaway centers on Chair Kevin M. Warsh. This was only his second news conference as chairman, and he faced a tough audience. Warsh has staked his reputation on vanquishing inflation, making price stability the sole barometer of his success. Yet after the Fed chose to hold rates steady, he was forced onto the defensive. He repeatedly pushed back against any suggestion that the central bank was sitting idle. There was nothing inertial about our discussions, our policy, or our strategy, he insisted. That language was meant to show that even without a rate hike, the Fed is actively engaged. Smith notes that Warsh has been unequivocal that the central bank under his watch will deliver price stability, and he used the press conference to reinforce that commitment. The third takeaway is about the tools Warsh says the Fed will use. Reporters pressed him on how exactly the central bank plans to bring inflation down. Warsh listed 3 main levers: the short-term interest rate, the size and composition of the Fed's balance sheet, and the broader financial conditions that affect credit availability for households and businesses. He emphasized that financial conditions have already tightened, giving the Fed, in his words, some comfort that we've got the ability and capability to deliver. When asked point-blank whether rate hikes would help tame inflation, Warsh conceded they could well be part of that solution, but I wouldn't say it's in isolation. That answer underscores a more nuanced approach than a simple rate hike cycle. The fourth takeaway comes from the market itself. Long-dated Treasury yields surged after the meeting, a move that signals skepticism about whether Warsh will actually follow through with tighter policy. The article points out that the jump in long-term yields suggests investors are not fully convinced the Fed's rhetoric will be matched by action, and they are demanding higher yields to compensate for that uncertainty. Smith writes that the market moves are notable because they reflect doubt about the chair's resolve. Colby Smith covers the Federal Reserve and the U.S. economy for the New York Times. That's the latest from the Federal. We'll have more on the Fed's next steps in future episodes. Thanks for listening, and we'll catch you next time.